Welcome to the Spreadex Financial Trading Preview, and we're going to look ahead at Intu Properties. They've got half-year results coming out on Thursday.
Yeah, really awful year so far. I think it's down 28%, which isn't necessarily a surprise given it's a company that owns a lot of major shopping centres across the country, and obviously retail is doing appallingly in the UK at the moment. I think one of the key things this year obviously was that it was looking to be going through with a £3.4 billion tie-up with Hammerson. That then was sort of dashed in April. Hammerson said they were pulling out. However, the stock was still falling quite sharply before then. So even though it saw a spike at the end of last year, there's still enough lack of confidence around the retail sector at the moment that even the prospect of that, even though it did eventually go away, wasn't enough to keep the stock at highest at the start of the year. However, its figures, I think it was first quarter figures were back in April. They weren't actually that bad. I think occupancy was up from 95.8% to 96.1%. I think it said that footfall was actually up 1.5%. However, that is stripping away the months that were blighted by the beast from the east. So that's perhaps a slightly disingenuous figure to have put out there by Intu. It also said that despite multiple issues at tenants like New Look and Toys R Us and Prezzo, companies have either gone into administration completely or that are having serious restructuring things that will remove various stores from around the country. And I think they said that would cost them £3.9 million, which is like 0.8% of 2017's net rental income. It still said it was looking at like-for-like net rental income growth of 1.5% to 2.5%, which suggests that they've had success in perhaps finding other companies. I think Zara was one mentioned, to go into their various locations around the country to compensate for the fall in those companies. The loss of those companies, sorry. In terms of what our clients are doing, they're heavily buying around the 180 mark. I think it's fallen so it's lost roughly a third this year. It's fallen so sharply in 2018 that it's one of those stocks that the slightest signs of positivity, whether it can muster that or not, might garner an oversized reaction from investors just because of how poorly it's done. Obviously, it is in a very tough sector in the retail sector, but I guess there's perhaps some slight difference between the high street and shopping centres. Not a huge difference, but perhaps enough that it can still post this 1.5%, 2.5% like-for-like net rental income growth. Obviously, any signs that it's going to be at the upper end of that as well will massively help it on Thursday.
Okay, thank you very much.